can sort of read that faster than I can say that. But predominantly, I have had about 30 plus years in banking, where I have run a number of senior roles, particularly with HSBC and prior to that, St. George Bank. And during that time, I've spent a lot of time in financial markets, talking to economists, particularly APRA and RBA, where I was key contact. So hopefully today I can give you my personal perspective on where I see the Sydney property market and where I see it actually going, more particularly in the next 24 months. Now, I do make predictions, and so far, most of my predictions over the last 5 years has come very close to being the truth. So I will try and provide insights and give you a frank view rather than a media view of exactly what's happening in the property market. Then we'll have time for questions in the end. We'll try to finish this presentation in about 45 minutes, and then definitely have time for questions. Okay, the last 12 months, most of you know what has happened in the property market, so I won't dwell on it. These figures are actually up to 12 months to 30th of April. But Sydney, as most of you know, in the year 2021, we've had a 25% growth in the Sydney market and in the regional areas as well. Very, very strong year. And what most of you may not realize is that this type of growth, like a 20% plus growth, happens very rarely in the Sydney market or the Australian market. So we have had two other times where we've had this type of increase. One was in 1989, where we had 29% increase, and 1950, we had 111% increase. I won't dwell back into history in terms of why that happened, but the more recent one, 1989, it's still in my memory. There was a period of coming out of a recessionary period, and there was a lot of economic growth happening, and there were a lot of really good things happening in the economy that actually caused that 29% increase. So as I said, this is history. You know about that. Today, we will talk more about where I think the market is today and where it is heading, okay? Now, when we're talking about the property market and looking at the 25% increases and the like, first thing I want to point out to everyone is it is not a single property market. So houses have performed very differently to apartments. And one of my key stories today will be that. So in Sydney, this is the 2021 numbers. So houses, on average, the median price grew somewhere north of 30%. And as some of you know, that some suburbs actually were growing at more than even 50% in that period. Apartments were more subdued. And this again is the average of all apartments in Sydney. So it didn't even go past 15%. But some of the more expensive suburbs in Sydney, when it comes to apartments and houses, they went up slightly more than some of the less expensive suburbs. So I can give you an example. Suburbs like Blacktown, suburbs like Liverpool, those suburbs actually did not have a significant growth compared to the house prices. Okay, there's a number of examples of that. So this is the median. Some of them were more like 3 to 5% increase, others were around 10, but this is the median. So huge disparity between house price growth and apartment price growth in that 2021 year. Now, what's making the news at the moment? So these are some of the headlines in the last few weeks. So you've all obviously just been through voting and elections, and there's been a lot of talk about wages growth. And on top of that, we have had a first official increase in interest rates since 2010. So 25 basis point, it was 0.1, now it's 0.35. We'll talk more about interest rates because that is what everybody is focusing on now, because it's the biggest headwind that is coming our way when we talk about properties. So, and there are lots of offsetting factors that I want to bring to your attention today. It is not just about interest rates. Okay, we'll talk more about that. Australia faces rental crisis. There is a lot of media now about rental crisis, shortage of properties, when in the midst of borders opening and immigration happening, which is the news down here. And then everybody now knows what the unemployment figure is, because even Albanese knows now that the unemployment figure is now gone below 4, it is 3.9%, and heading lower. So this number probably in the next 6 months, or maybe by the end of the year, you will see this tracking closer to 3.5%. Okay. One of the things that is going to somewhat offset this trend is the migration and influx of skilled labor, which we absolutely need in this country. That'll have an impact, some impact on this, and it'll also have some impact on the wages growth. So we need to watch this space when we're talking about the impact on property market. Coalition announces super home buyer scheme at federal election campaign. Well, this won't happen anymore, but now we're going to have the Labour government putting in their new scheme, and you will hear more about that, I guess, as they settle into government. But this is what's making headlines at the moment in terms of what's relevant to the property market. When we talk about the property market, there are a number of key things we look for that actually moves the needle when it comes to price movement. And this is my top 7, and in some sort of order as well. Supply and demand, Economics 101 tells you that absolutely any commodity that you're looking for in this world, supply versus demand causes the prices to go up or down. So if you've got too much supply, prices are going to be down. If you've got too much demand and not enough supply, prices definitely are going to go up. So that was one of the biggest factors, that demand was significantly higher than supply in 2021, causing the prices to move up as far as it did. Coupled with that, the second point, interest rates have been at record lows. So because of COVID, we brought the rates down to cash rate down to 0.1%. The cash rate is the determinant for the variable housing loan rate. And so the variable housing rate really came down as well. And the interest rate swap rates, which is a derivative which the fixed rates are based on, that also came thumping down. So we had rates which were fixed rates at below 2%, which we've never seen in Australia ever. And I have been here 40 years. I can tell you that these rates are at historic lows, okay? And with interest rates coming down, your affordability obviously goes up. So affordability went up, which means there are more people in the market, there's more demand, and there was not enough supply. All of these two factors were probably the main factors that caused the property prices to go off as far as it did. Third one is very important. Regulator is absolutely critical. APRA is our regulator for banks. Banks are the primary lender in residential mortgage space. And coupled with that, the bank's lending policy and appetite. Lending policy is somewhat determined by APRA. Appetite, and I've been dealing with APRA for the last probably 30 years of my career. And I can tell you a lot of insights in terms of how they think and how they manage the regulation that they have on the bank's policies, okay? Appetite for banks to lend is very, very important. If the banks don't lend you money, property market is going to fail and fail badly. Well, I will tell you that the big 4 banks, which make up 80% of the residential mortgage market in Australia, the big 4 banks, 50% of each of those big 4 banks' balance sheet is actually residential mortgages. That is the bread and butter for banks. So if you pick up a bank's balance sheet in Australia, whether it is NAB, ANZ, Westpac, or CBA, the balance sheet is somewhere north of $800 billion. Out of that $800 billion, you will find that half of that bank's assets is actually residential mortgages. That is their bread and butter. There is a 2% margin that the banks generally make across their whole mortgage book. So if you take $400 billion and multiply it by 2%, that is a significant amount of revenue that a bank makes every year, okay? That's why when you look in the health of a bank, you see mortgages and how they perform is very, very important. Then we move to the economy. Of course, the economy is important. Of course, the economy moves the price on properties. Okay, it is an important factor because one leads to another. If you have recession, if you have negative growth and a recession, so if your GDP is not growing, and if you have very high unemployment, as we thought we might have in middle of 2020, when we were right in the thick of COVID, everybody thought doom and gloom, GDP, we're going to have a prolonged recession. We're going to have unemployment hitting 12% and north of 12%. And that's why everyone in the market thought that the property prices could have a fall of somewhere between 20 and 25%. It was more because of these two factors. Okay. Now, neither of these two factors actually happened. And in middle of 2020, I predicted against the market that in 2021, we're going to see an increase in property prices of at least 20%. And I wrote an article in the paper actually going against every economist in town at that time. And with hindsight, I'm glad I did, because I did not believe that these two things are going to happen to the extent that they were talking about. So economy, very important, and we will touch on economy shortly. Government spending, infrastructure, incentives, JobKeeper, housing incentives, and all of those things about that were spent by the government, significant amounts of money still to be spent by the government to ensure GDP is in check and the economy continues to grow, and also ensure that unemployment is. If you're going to throw a lot of money at these things, you are going to get the economy to grow, and you are going to get unemployment to come down as far as it has. So we will, as I said, we'll talk more about that. The sixth point here very quickly is what we call delinquencies and loan write-offs in banking terms. And loan write-offs are, again, talking about residential mortgages here. So if this was an issue, the economy, you would see this happening. Okay, so they're interlinked. These two things are very much interlinked, number 4 and number 6. If you don't pay your home loan for 1 month, 2 months, 3 months, you are on a worry list of a bank. 4 months, you are more than a worry list. You get a knock on the door and they will start talking about putting your loan in your house in a what we call a mortgagee in possession sale. So they take possession of your house, and they will do an auction, and they will sell your house to recover their loan amount. We do not see a lot of this type of things happening. Haven't seen it for a very long time. The last time I saw this happening was in the early 80s, when we did have a recession and interest rates were at 17.5%. I have not seen it since then. Okay. Of course, there are some mortgagee in possession sales, isolated, but nothing to talk about. And the reason for that is we have very good employment in this country, and people do have enough money to actually pay off their housing loans. People in Australia pay their housing loans, whether they need to get a second job, drive a Uber, or do whatever they have to do to actually pay their housing loan. They might not pay their personal loan, they might not pay their credit cards, they might not pay their car loan even, but they do pay their housing loan. So there is very minimum negligible write-offs that banks have on the residential mortgage books. Okay. And the other thing is the APRA regulation at the moment states that you've got to use a 3% buffer on the ability to pay and service a loan. If the variable rate is at 3%, you will be assessed at whether you can pay your loan at 6%, because that's the 3% buffer that they use. So with that type of buffer, and it's quite a conservative buffer, the banks used to use a 1% buffer. So when I started out in banking in Australia, we set our own buffers. APRA wasn't regulating it. We just set a 1% buffer. So if interest rate was 6%, we just said we'll use 7 and see if the consumer can pay at that. Now it's 3%. It is very, very rigid. Okay, the 3% is very rigid and probably world leading in that sense. So the chances of you seeing delinquencies and write-offs very, very low. Okay, the chances. The media, do not trust anything the media tells you. You've got to very critically analyze the media, because they have been significantly wrong in the past. Global factors is very important. The two factors here, which I haven't been talking much about in the past, COVID-19 and the war that is going on at the moment. These two factors actually can have a direct and indirect impact in terms of our property market in Australia. Now, the war is having oil prices to go up. It's got supply chain issues, okay? Wheat prices are going up. Essential commodity prices are actually going up. With that going up, it is causing inflation. With inflation going up, we're seeing interest rates go up. So it has a knock-on effect. COVID-19 caused supply chain issues, okay? And we saw prices of cars go up, for example, and all those type of things. So all these factors are at the bottom, but sometimes it can rear its head above number 7 and come up the chain in terms of the impact it can have on the property prices. 9 times out of 10, though, the global factors are not going to have a major impact on your property prices. It'll be more this type of thing here in the first 4. Okay, moving on. So interest rates just went up, and the media is telling you that there is doom and gloom out there, and everybody watch out because interest rates are going to go up a good couple of % in the next short term, okay? Now, just a bit of history. Last few weeks, what has happened in the last couple of months? Inflation has been much higher than we expected. We expected inflation to be about 3% by the end of this year. But the global factors, mostly the global factors, whether it is oil prices or other underlying inflation, we have had floods here, we have had bushfires here, we've had all kinds of issues here in Australia, which has caused food prices to go up. Essential food items have, you know, we buy fruit and vegetables every day, they have gone up. Rentals have gone up, oil prices have gone up. There are a number of things that are causing inflationary pressures that comes into the measure of what we call the CPI, okay? With inflation going up so much, we had no choice but to increase interest rates. The second factor was, and keep in mind that interest rates were at historic lows. Wages growth is picking up. Unemployment, as I've just said, is at 50-year lows, heading there anyway. We're at 48-year lows, but soon it'll be 50-year lows. So it was the right time for the RBA to say, listen, we've got to do something about pegging back the inflation. And the only lever that they have really to pull is we have to raise interest rates. Now, where do we go from here? We should expect another, in my personal view, this is my personal view, we should expect another 2 to 3 increases of 0.25% this year. So we will get somewhere around that 1% at the end of the year. The pace of growth, though, the market is different. So when you look at the market, when I say the market, I mean the futures market. The futures market in Australia is already predicting that we're going to be north of 2% by December. That is not going to happen. Okay, that is not going to happen for a number of reasons. The RBA is going to be very cautious as they move interest rates. They're going to be extremely cautious. And so the pace of growth of interest rates will depend very much on how quickly we can resolve the supply chain issues we're having. How long is this war going to go for? How long are we going to see our local fruit and vegetable prices being up? And so on. And also, so some of the, and wages growth is very important. So with the influx of people, and see, wages growth is needed when you have inflation running higher than where wages growth is. But if inflation starts coming down, then, and that could happen through some of these global factors and other factors locally, and wages growth actually slows down, then the RBA is going to reposition itself. It's not going to follow the futures market. The RBA governor was asked a very simple question. Do you see interest rates at above 2% by the end of the year? Because that's where the futures market is. And I think the Reserve Bank governor laughed at that and said the futures market does not decide where we see interest rates. So listen, all you need is inflation coming down and wages growth showing signs of being more subdued, and you are going to see the Reserve Bank change tack again, okay? So I am predicting another 25 basis points on in this first Tuesday in June, which is coming up very shortly. And then the RBA will probably wait and see. Now, some economists are going out and saying it could be 40 basis points. It could even be 50 basis points in early June to see, for them to pack back inflation and then watch what the figures are going to be. These figures only come out quarterly, by the way. So this will be very important. And the RBA is going to show extreme caution at doing that. Inflation is running not at 5.1, but a lot higher in the US and a lot higher in the UK. We're talking 9%, okay? Some very large numbers. So we had to do something at this inflation rate. There's no choice almost to the Reserve Bank. So the RBA governor has also very clearly said that the potential for cash rate to get to 2.5 by late next year or 2024 is likely, okay? And why is it likely? Now, of course, they're going to be cautious, but we all need to keep in mind that before COVID, we were all paying, anybody listening to me today, we were all paying mortgages at 4%, 4.2%, 4.3%, 4.5%. We were all paying those mortgages. So the fact that we've had a honeymoon period for the last 2 years at paying 2.5% and lower in some cases, it has been just that. It's been a honeymoon period. This is one of the reasons why people have saved so much money through COVID. Okay, the mortgage rate goes up. If you've got 3 or 4 properties, then your mortgage rates have gone up significantly. And I can tell you, and I do own quite a few properties, because I've been investing for 40 years, but I can tell you that it made a huge difference in terms of how much money I was forking out of my pocket. So for me to go back to where I was in 2019 is, to be honest, no big deal. Okay, it's no big deal. The media is trying to make out when you're going to go down to 0.1% and suddenly you're going to go up by 2%. It's not the end of the world. We were at historic lows. Okay, media makes out that mortgage delinquencies are going to go through the roof. People will not be able to pay their mortgage. They won't be able to buy their food. They will be starving in Australia, and people will be selling their houses left, right, and center. Absolutely not. Scaremongering. Okay, if you listen to that, you are not going to buy a property in Australia. So it is not a big deal. We are right down here, okay? We're slowly going to creep up, We've come from, yes, for my first property in Australia, I paid 17.5%. So I can vouch and I can tell you that we are at historic lows. And even if it goes up 1%, it is not the end of the world, okay? There are a number of factors I'm going to talk about today, which will tell you why it is not the only factor that's important. Now, the last time we had an interest rate upcycle, firstly, 2002 to 2008. During that period, interest rates went up 3% in this 6-year period, 3%, 300 basis points. Prices of properties were up 30% during this period, 30%. Now, I told you that 25% doesn't happen. It's only happened 3 times in the last 100 years. So 30% in this period is still very, very healthy. And it happened at a time when interest rates were going up by 3%, okay? This is a good comparison, in my view, with the current period, because interest rates are going to increase quickly, could increase quickly, and because it is a period of strong wages growth, which we expect to see, okay? So this is an interesting comparison that we have in this period. Now, 2009 and 2011, home prices were up 11%, and interest rates were pushed up by 1.75% again, that period. Okay, so these are 2 interesting comparison periods where interest rates went up, property prices still went up. So we will talk a bit more about that in terms of what are these other factors that you need to be factoring in rather than listening to the media. First, coming back to Sydney and what is happening here. This is a very important slide for you because this is not my slide. This is a slide from New South Wales Treasury. They do the predictions. They know the numbers. They have a breakdown suburb by suburb. in terms of their projections of population growth, demographics, infrastructure spend, all those type of things, how many people will live in each house and so on. So by 2036, these are some of the very key things you need to have a takeaway today, okay? By 2036, we're gonna have 6 million people living in our city. And by 2054, we're gonna have 8 million people living in our city. This is one of the fastest growing in the Western cities in the world in percentage terms. It's a massive population growth. To cater for this growth, we have got to have 38,000 dwellings, nearly 40,000 dwellings per year. Now, these numbers have been done for a few years now, okay? Now, the reason why we need 40,000 dwellings nearly per year in this city for the foreseeable future is because we get normal year, we get 95 to 100,000 migrants, net migrants into Sydney every single year. Now, there's been a pause for the last 2 years, so all of you know that. And that pause has been because of COVID. Now, what we need to understand is that there's going to be an influx of people that 95 to 100,000 could exceed. And in the next 18 months, it could become 200,000 people coming into our city, okay? If you think we have a large number of surplus properties at the moment, you need to think again, because we do not. So if we're looking at a normal year's migration, we need 40,000 dwellings. We are going to be chronically short of that number, okay? And the government needs to start to fix that now. In terms of infrastructure, just transport projects alone in the next 10 years is over $50 billion. What you are seeing in Sydney at the moment, Sydney is being transformed. This is a paradigm shift in our city, what happens once every 50 years. What we are doing is we are trying to cater for our population being 8 million by 2054. For that, we are rezoning a lot more land close to metros and train stations. We're building more metros. We're building roads under the city. All the tunnels are being dug everywhere. We are building hospitals. We're expanding hospitals, we're expanding schools. We're building a new airport. We're building Metropolis. All of these things are infrastructure that is going on in your city, which is massive. We have more infrastructure projects in the next 5 years in Sydney than the rest of Australia added together. Okay, so there is a lot happening in our city, which is important, which will keep the job numbers low. Our job numbers are below 3.9. They're more closer to 3.6 already in Sydney. Okay, you cannot find 3% of the people don't work anyway. So to find a person, to employ a person at the moment is probably the most difficult time we have had in our history. And there is more and more work about to happen. So what's that going to do? Unemployment stays low, economy keeps growing. This is a perfect storm in terms of the impact that will have on property, okay? If you think one factor like interest rates is going to impact it, you got to think again. What are the experts saying? These numbers are a little bit old, but when I say a little bit old, it's about 3 months old. But what I'm saying, the experts are the big 4 banks, okay? You can trust them if you want. They're the same big 4 banks, economists, that came up with a 20 to 25% fall in mid-2020, and we've seen a 25% increase last year. This year, they're predicting, all of them predicting an increase, okay? And then next year, they're all predicting a fall. CBA, always the most pessimistic bank when it comes to falls. I haven't got the NABS graph there, but it is also a 5 to 6% fall, and then Westpac 6% fall. Take it with a grain of salt. This is not, you should not base your investment decisions by looking at this chart, because if you do, you will not do well in property. Now, SQM research, I do respect SQM research. I look at their research, and I also look at CoreLogic and what they tell you, because they're big research houses, and they have some sensible reasoning in what the numbers that they put out. Again, Sydney. So this was 2021. So they've got a number of scenarios here, and I'm not going to go through this very busy slide, but you can see that the numbers are very subdued, -2 to +4, -3 to +3. At least they've got some pluses there. which is encouraging. And the worst scenario is here, -7 to -2. So it's not doom and gloom. Okay, it's not doom and gloom. I will say to all of you, one thing you've got to remember is that you've seen that we've only had 3 years in the last 100 years where we've had more than a 20% increase in 1 year in property prices in Sydney. I will also say to you, in the last 100 years, in terms of property prices falling, okay, in terms of property, well, let's just use the last 30 years. In terms of property prices falling, we have never had a more than a 5% fall in property prices in any particular year in the last 30 years. Make it 40 years. We haven't. Okay, please go and Google and have a look. So for these people to come out and say property prices will fall 10 to 20%, they do not know what they're talking about. For the 20 to 30%, any of those numbers above north of 5, you are going to be talking about huge amounts of delinquencies. It is not going to happen. You just saw the numbers. Okay, it's not going to happen. So keep that on the back of your mind when anytime you hear in the news that somebody is predicting a 15%, 20% fall in property prices, they don't know what they are talking about. Absolutely have no idea. Okay, they want to make headlines, and headline sells. I'm sure when you see a headline that says prices to fall 20%, everybody clicks on it and goes in to have a read. So that's what sells news, okay? But it is too far away from the truth, and these people have to be made accountable, to be honest. So why should you buy an apartment now? Now, I'm going to show you in a minute, and you all probably know this. There's a huge gap that has developed between house prices and unit prices. The gap is going to start to close now. Between now and end of next year, this gap that I'm going to show you a graph in a second is going to start to close. The reason why it's going to start to close is, firstly, we have got all these things happening here: migration, return of students. Okay, there's a large percentage of population who cannot buy homes. They will have no choice but to buy an apartment now. There are going to be higher rental returns, and demand for units will outstrip supply. And we'll talk more about that in a minute. So what I propose to you, and I'll show you why you should buy an apartment now. But what I'm proposing to you is you go and find a value for money apartment now and lock it in. Lock in the price for today. It's what I call gearing with price arbitrage. You go and pay your 5 or 10%, whatever the developer is looking for. That apartment will not finish in 12 months, 18 months, sometimes 24 months. You've only paid 10%. And when the time comes to settle that property, if that property is gone up in value by 10%, you have more than made back your money, okay? So this is a perfect time to buy an apartment, and I will tell you why. Now, first and foremost, as I said, there is this large gap. So if I go back to middle of last year, March last year, when COVID, everybody knew about COVID, we're here. So this is the red is the house prices, the blue is the apartment prices. So you can see that they were always very closely aligned in terms of whatever happened to them, right? So yes, March 2019. So everybody knows that there was a fall of around 5% in, this is one of the classic years that we've had, March 19. So property prices peaked that year, and then by the end of the year, you saw a bit of fall. Now, this is the gap I'm talking about. This is houses, this is apartments. This gap has widened. This is the widest gap I have seen between apartments and house prices in the last 40 years I have been here, okay? This gap has to close. I call this period the perfect storm for apartments. So I told you that the biggest headwind is interest rate. Yes, the biggest headwind is interest rate. But I'm going to tell you 8 factors now, my top 8 factors, which will offset the interest rate increases. First and foremost, there's still a high appetite for banks to lend, very high appetite. As I said, mortgages is their bread and butter. They will continue to lend more in that space. You will see significant competition. You saw the significant competition when banks were handing out $3,000 to move your loan to them and so on. And that was when interest rates were 2%. But now you're going to see rising interest rates, and you're going to see a lot of competition in the market because banks do not want to lose their market share. Okay. And we're still at low interest rates. If it goes up 1%, like I said, it's not the end of the world. Okay. It's still a very, very low interest rate environment. Demand and supply was my number one point. So demand is going to come from all of these things here. Okay. I won't go through each of them. You know what I'm talking about. Supply is significantly down and heading lower. Firstly, the release of new land is lagging demand. You all know when you're looking for land at the moment, it is difficult to find land any suburb in Sydney. There were a lot less apartment, I'll show you a graph in a minute, a lot less apartment commencements in 2021 and 2020 as well. And the reason for that was COVID, okay? So, and you got supply chain issues, and there's fewer properties certainly on the market. In some places, there are chronic shortages of properties, okay? Now, this is one of the most important graphs when we're talking about apartments. Your takeaway for today, in terms of supply, between 2020 and 2021, there were very few starts in apartment construction. It takes a 3-year period to start and finish a project, okay? So this is the completions, 14,000 completions in 2022. So these completions here started in this project started in 2019, pre-COVID. Once you start, you got to finish. 2023 completions, so you're starting to see the impact of COVID. A big fall in terms of the number of completed apartments. 2024, chronic, 4,500. It hasn't been this low for a very long time. So this is a big story in terms of supply. Supply is going down. If anybody tells you that we have got too many apartments in Sydney, I'm telling you they will eat their words by the end of this year. There'll be a chronic shortage of apartments. I'm not talking about the apartments that are going to finish in 2025 or 2026. You would expect that this year we will see more starts, and they will finish in 2025 and 2026. I'm talking about this chronic shortage, short term, 2023, 24. You cannot build overnight. Please keep this on the back of your mind. So bookmark this. Now we will talk about the other points. The cost of construction, we all know, has already gone up about 20%. There's supply chain issues, there's inflation. Every developer is telling you property prices, cost of construction is gone up. It is probably going to go higher. In my view, there's another 5 to 10% higher to go. If you lock in a price today, they cannot increase your price. You change contracts today on a apartment, they cannot change the price. So that's another reason why you need to lock in that price. Rentals are heading up and up, and there's now a chronic shortage of properties. We've got graphs to talk about that. People who could not afford a home. We are now getting a lot of people who said, you told us in 2019, you told us in 2020 to go and buy a house and land, or you buy a house, and we didn't. We waited because we believed that it's going to come down in value. Then we missed out in 2021. Now I need to buy something. We've had at least in the last 2 weeks, we've had like 5 people like that who are saying, I need to buy something, just find me a property. So they can't afford the $1.5 million house and land package in Box Hill, but they want to look for a 2-bedroom or 3-bedroom apartment. They want to get into the property market. They want to buy anything. They've got equity. Some of them have got funds, but they want to get into the property market. That is going to push the apartment market prices up. When you look at that and the supply that's coming, the shortage of supply that's coming, there's only one thing that's going to happen. These two things are very important. And a lot of people have been asking me in this last week, with this election change, what is going to happen to the property price? Labor coming in, is it going to be doom and gloom, or is it going to be good? Each had a particular policy for first home buyers. Keep in mind, the first home buyer market does not move the needle on property prices. Okay, it does not. There is a much bigger property market than first home buyers. There's the second home, third home, fourth home. There's all the investor market. There's a massive market out there. So if consumer confidence and business confidence is at high levels and continues to be at high levels with the change in government, in my view, then you have got no change, irrespective, indifferent who is ruling at the top, indifferent, okay? The other factors are more important. We just want to make sure that consumer confidence and business confidence stays high. Business is still investing money. Business is still hiring people. People, like everyone listening today, are still spending money. Because there's a change in government, do you still go and do an extension of your house? Do you still go and buy a new TV and a new car? If that hasn't changed for you, then your answer is right there. No change, okay? No change. So I've seen some graphs where people have put Liberal government was in power for these 3 years and look how much property prices have gone up. Irrelevant, irrelevant, okay? Media overanalyzes things. And then we've got a strong balance sheet, our government. So these 8 factors are gonna be the perfect storm for apartment prices going up. Now, a few anecdotal evidence, real evidence. Unit inquiry volumes in the first quarter of 21 versus first quarter of 22 has surged 22%. So this is what we are seeing in terms of inquiries. Okay, growth in this from here to here. Land 3% higher. House still higher though. Okay, house 4% higher. Units 21% higher. Okay, these are real numbers. These are not my numbers. This has come from realestate.com. They know where the inquiry volumes, they are the biggest site and they know inquiry volumes have gone up significantly for apartments. Now, I did say I'll make some predictions. Sydney is not a single property market, okay? So my general comments on the price ranges are very important. Different price ranges will behave differently in my view. Your biggest demand in the next 24 months during an interest rate rising cycle is gonna be in this price range. The 500 will disappear soon and become 650 because there will be no property prices in 500 in another 2 years' time. This price range is going to have high demand, high price growth, and high returns. This is where the investor market is as well. Okay, everybody wants to look for properties in this price range. This second one will be a steady market. I believe that there will be more interstate migration happening where people take advantage of the sale of their property in Sydney and move to regional areas and maybe move to interstate. And so you will see slightly increased supply in this space, and mostly flat, but could in fact also be a slight increase. The area where I see there could be a correction if interest rates do go up steeply is not in here, but in this price range. Keep in mind during COVID, where I said your property prices have gone up 50 to 60%, even in some suburbs, Warunga, Kilara, 70%, some eastern suburbs, Manly, some suburbs have seen like absolutely exponential growth during that period. That's where you're going to see a bit more correction. Once you're in the 5 million plus and 10 million plus, there's always going to be overseas demand for those properties and you'll probably still see moderate price growth. So overall, this is my prediction on an overall basis. Houses, 2022, so blue is houses and this one is apartments. 2022, you're going to still see a 5% increase in house prices, but you're going to see a 14% increase in apartment prices. These are my personal predictions. Next year, you are going to see a 1.5, still an increase in house prices because of all of the factors I have mentioned. It's not going south. It's still going to be an up on a total median basis. And apartments 6%. So overall, between now and the next year, I'm saying 6.5% for houses and 20% for apartments. This figure, if all my 8 factors are humming along, could well be 25% or more. Okay, I am very bullish about apartment price growth to bridge that gap that we talked about. Now, this is today, 26th of May. Okay, I saw this news and I had to put this in here. You are going to see more of this type of headlines in the coming 12 to 18 months. So in Maryland, a 3-bedroom apartment has sold for $1.1 million, smashing the suburb record by 300,000. The last time the record for Maryland for a 3-bedroom apartment was $795,000. It's now 1.1. You are going to see these headlines. Okay. You've seen these headlines, suburb records, house street records for houses. Brace yourself for the 18 months from now. You're going to see more and more of these headlines for apartments smashing records. The property clock for apartments is the start of the recovery. It's a rising market. It's going to be approaching peak by end of next year. This is, again, this is my prediction. Okay. Media is starting to talk more about apartments turning around and becoming more in vogue. I said I'll talk about vacancy rates. Taking a lot of time already, so I'll go through this quickly. Vacancy rates are falling. If you see Sydney, we peaked at 4%, by the way, in the middle of COVID. We were 2.9 a year ago. We are now at 1.4. I predicted in middle of last year that by June this year, we will be at 1%. We are very close. Second half of this year, we're going to be below 1. We're going to go below 1. Okay. That is chronic. That is a chronic shortage of properties. If we get to 0.5 as Perth is, if we get to 0.2 as Adelaide is, if we get even to 0.7 as Brisbane is, which we will get very, very shortly, it's going to come from here to here, rentals are going to go through the roof. I'm expecting your rentals are going to go up anywhere from 20 to 25% in the next 12 months. If you're paying $500 now, you're going to pay $600 a week. You're already seeing that with houses. Now you're going to see that with apartments. So demand for unit rentals is increasing far more than demand for house rentals. There's a shortage of properties. All these migrants and students and expatriates returning, it is gonna, I don't know how we're gonna cope because you can't fix this problem overnight. In the next 6 months, you're gonna hear more and more and more about the chronic shortage of properties for rentals, and people will have to sleep on the streets. I don't know where they're gonna sleep. So units increasing 108% in terms of demand for unit rentals, okay? This trend is gonna continue. So we've got economic growth, jobs growth, wages growth. All these 3 things are happening. Population growth is happening. All that brings, this is the simplest graph for everybody to understand, nothing complicated. Rental and buyer demand is definitely going to increase. When these 4 things happen, this is going to increase. That, not interest rates, all these factors and all the other factors I've talked about is going to increase the property values. Okay, so hopefully you get that. When you're buying a property, you must understand that it's not just about location. Location is very important because of these 3 factors. I'll let you read that. Price is important. You need to buy at the right price. You cannot and should not ever pay a premium for a property. You need to know and do your homework and due diligence, which we do for you in a lot of our projects. Timing is very important. Timing cannot be better than now. Your developer and builder is very important. Okay, you need deliverable products. When we talk about infrastructure, these are some of the things that we talk about: the metro, the hospital, business centers, where people are investing. Okay, Marsden Park, Riverstone Town Center. These places have boomed when it comes to housing prices. These places are ready to boom when it comes to apartment prices. Okay. When you're looking at New South Wales, we're going to see strong population growth. Our economy is bigger than these countries. Just New South Wales economy, bigger than Malaysia, Singapore, Hong Kong. Okay. We've got a new airport coming up. We've got Atropolis coming up. We've got more jobs being created. It's all happening in our city. I wrote an article recently talking about what I'm talking today in the Indus Age. You can read it in the December edition, because all of these factors are very important for you to understand why apartment prices are going to surge. Now, before I hand over to Chris, my colleague, and he'll talk a little bit about the two projects we're showing today. Conscious of time, we'll go through these quickly, but I just want to say that we have a significant number of projects in Sydney, of course, interstate and region as well, but in Sydney, we probably have about 50 projects that we can showcase to you. But what we do is we value pick the projects that make most sense for us and that where we would buy ourselves. And that's why we are going to show you two projects only, the projects that will give you the biggest bang for your buck. These projects are one in Blacktown and one in Tallawong, Rouse Hill. And I'll hand over to Chris now, who will talk through this.
Thanks, Sachin. Good evening, everybody. My name's Chris from the Nivas sales team. The first project that I wanted to showcase was Evoke Blacktown. Now, this particular project is, as you can see, it's a very nice facade, well-designed building. There are two stages. Stage one, which is what you see in front of us here, completing in July, where we have a selection of one-bedroom apartments, large in size, up to 62 square meters internal, available for sale. Across the road from that, we have stage two as well, which we're just about to launch. And I'll get into pricing, etc., in a minute. But location-wise, it is perfect. So it's about 5 minutes walk to everything. The developer, now Jasara are the developer who are building this project. They're a developer builder. They've been around for about 25 years. They've done a selection of many different apartments in the past. They've built for other developers, built for the New South Wales government. They've built for quite a few different people, as well as himself. So as you can see, Villa Del Mar, Honeyeater Grove, the Wave in Rockdale, which is a very prominent building on Princess Highway. So some really, really well-designed, well-built buildings in their portfolio, which is a big plus. Now, if we have a look here, Evoke stages 1 and 2, which is where that blue box is, are literally 5 minutes walk to West Point, 5 minutes walk to the train station, 10 minutes walk to the new university, 10 minutes to the CBD. So it is perfectly located. Fast trains will take you into the city in about 40 minutes, if I'm not wrong. So look, very, very good location, very good developer. Truly one of its kind. Yeah. So if we move across, this is a little bit more emphasis on what's happening in Blacktown. So hospital has undergone if I'm not wrong, a $600 million upgrade, if I'm not wrong. There's also been West Point, obviously that's been renovated over the last few years as well. University, so you've got a campus not too far away. So look, everything is within walking distance or within a 5-minute drive. So absolutely amazing in terms of location. Now, just a quick look at the finishes. So you've got 2.7 meter ceilings. You've got 20 millimeter stone bench tops, ducted air conditioning, wood floors, plush pole carpet. So really well finished. For a Western Sydney suburb, this is extremely well finished. The bathrooms are not dissimilar to a 6-star hotel. So when you walk in there, you got floor to ceiling travertine look tiles, and it's really, really nicely done. So then you've got a rooftop terrace as well. So just a place where you can go and chill out, have a barbecue, that sort of thing. There's no pool, there's no gym, there's no sauna, there's none of those things. So strata costs are relatively low as well. That's something we place quite an emphasis on with all of our projects. And just to give you a quick synopsis as to pricing. So stage 1, we have 1-bedroom apartments available from $436,000. Now, if you look online, the starting price for a brand new 1-bedroom in Blacktown is sitting at about $460,000, if I'm not wrong. So big differential in price, big units as well, good aspects, all north and northeast. So that's stage 1. Stage 2 will be launching shortly. We are taking expressions of interest for that. Basically, stage 2, your 1-bedroom apartments, will be starting from around the same price, around that 430 mark. Your 2-bedroom apartments will be starting from $540,000. So 2-bedroom, 2-bath, 1 car. This is average internal size of 80 square meters internal for 540. If you look online, the nearest competitor is about 570 for a brand new 2-bed, 2-bath, 1 car in Blacktown. So significantly under market, very good developer, really good location. So I'm talking, like I mentioned, walking distance to everything. And they're not massive projects. There's 100 apartments in stage 1, 130 in stage 2. So, and we do have some additional incentives we can, of course, discuss on a one-on-one basis. Yeah, so look, some really, really well finished product. Now, the next one we have is in Rouse Hill. Now, this, what you see in front of you, that dome shape you see in the front there, that's actually the Tullawong Metro. Now, in front of that, what you're looking at with that triangle shaped building in the middle, stage 1 of this particular project, Tullawong Village, was the fastest selling project, one of the fastest selling in 2022. 333 apartments sold in 9 weeks. Now, I'll tell you why. Stage 1, your first floor is basically going to be shops. So you're going to have 40 specialty shops. It's going to be like a very compact version of Rouse Hill Town Centre in a sense. Level 2, so that's an image of what the shops are going to look like. Level 2, you're going to have doctor surgery, pathologies, clinics, that sort of thing, which is again is going to be quite convenient. And from level 3 up to level 8, you're going to have your apartments. Now, the apartments, not high rise, well spaced out, lots of greenery, lots of privacy. So very, very well done. As you can see here again in this image. The finishes, guys, are amongst the best. Probably I'd say amongst the best in the whole of the Northwest. You got 40mm stone bench tops, 2.7 meter ceilings, proper engineered timber floors, which can be sanded down 3 times in their lifetime. You got reverse cycle air conditioning. Bathrooms, I would go into more detail into this. There's some really special features about these bathrooms, which set them aside from any other developer in the Northwest. But again, nicely finished, good LEDs. We can get into more detail when we meet for an appointment. And again, so where the project is highlighted in that light gray, behind that is actually the ponds, right? So the ponds, your average house price there, you're looking at, if I'm not wrong, median house price around 1.3 mil, something to that effect. So you've got houses which are very, very expensive across the road. And you've got this amazing apartment development, which is coming up across from there, directly across from the metro. So you've got that, you've got Rouse Hill Town Centre, 1 stop away. You've got your own shops underneath. You're within some very good catchments for schools as well, which we can get into more detail. Rouse Hill Hospital is not far. Like I'm talking a 5-minute, not even 4-minute drive, 1 stop away. And of course, Norwest, Norwest Shopping Centre, Norwest CBD, that's not too far away as well. So really, really convenient. And a lot of scope for future growth. Now, one thing I want to point out, stage 1 of this project is finishing towards the end of next year, right? Stage 2, which is what we're selling at the moment, is finishing in 2024. Now, the metro is actually earmarked to finish stage 2 by 2024. Hopefully that happens. Now, when that happens, that's going to cause a significant spike in property prices in that area, in my opinion, and Sachin's, simply because you got connectivity to the CBD directly, right? From somewhere which is essentially 50 k's out from the city, you've got direct connectivity in an air-conditioned, quiet metro taking you straight to the CBD. So and of course, when stage 3 comes up, you're going to be connected to Badgerys Creek. So the connectivity within a 100 to 50 meter walk is just unbelievable. So next slide. So guys, pricing for this. So 1 bedrooms are starting from about 540, 2 bedrooms from about 675, 3 beds from 940. We have some incentives which we can discuss with you. As discussed, stage 1 was the fastest selling project in 2022, or one of the fastest selling projects, 333 apartments in 9 weeks again. Now, stage 2 is having quite a similar momentum. There are more buildings available in stage 2. We've sold out almost of the first one. Second one is kicking off within the next week. So we are taking expressions of interest for that. So The location is fantastic. The the finishes are great. I didn't even talk about the developer. The developer's Daycorp. Daycorp are the third largest developer builder in Australia. So it's got ticks every single box. And with migration coming in, as Sachin mentioned, it's all about convenience, right, guys? So not everyone who comes in is going to have a car. So walking distance to everything, well finished, a good little vibrant community of its own, and destined for good things. So I'll leave you with that. Thank you.
Okay, conscious of time, some concluding comments from me. So when we're looking at these two projects, as I said, we have done significant work in terms of value picking the right projects at the right price for you to get in. And both of these projects from now, so you have an opportunity to pay your 10% and actually wait and see the growth happening. You're buying at the right price. Now, right next to this Talawong village. So sorry, coming back here. This is Talawong Road going in. We were selling land at Talawong Road 18 months ago at 300 square meter blocks for 550. And today the prices are 920 to 930 for the same blocks, 300 square meter blocks. So that's not a 30% jump. That is like 80% jump. Okay, so you've seen the in Ponds. Christian probably lowballed the figure. If anybody knows anybody in Ponds or lives there, the prices they have seen probably a 50 to 60% jump in property prices in 2021. So these are sought after suburbs. This is a quality development right next to a metro. We know that when you buy next to a metro, you are buying a premium project. Okay, we have seen that happen in Macquarie, where you can't buy a one-bedroom apartment now for under 750, and that won't even have a parking spot. We have seen this happen in Castle Hill. We've seen this happen in Nivas and Bella Vista, and this will be absolutely no different. Okay, from here you are going to be like 4 stops to Badgerys Creek. To have this type of quality development right next to a metro, you're picking lifestyle. And at these prices, I mean, I can assure you that in time to come, a 2-bedroom apartment in 2030, you're not going to be looking at anything in Sydney below $1 million. Okay, it is going to happen. It might sound ridiculous today, but it is going to happen. We were selling in 2014. We were looking at apartments in Blacktown. 2-bedroom apartments in Blacktown were 270, 280. So we're double that now. We're not even like 7 years from 20 to 8 years now, right? So listen, you've got to make your right investment decisions, but you've also got to buy at the right places. Yes, we can find you cheaper places. If you go a little bit further in here, we'll find you cheaper apartments. But these are quality premium apartments which you need to put into this is where people live. So when I said I would buy something that I show my buyers, I've already bought 2 in here. Okay, a 1-bedroom and a 2-bedroom. So we believe in the product, and that's why we're showing it to you. Now, my concluding comment for you, as I say to everybody, is to get rich and to get ahead in life, you must invest in property. Absolutely must invest in property. If I said to any of you listening today that if I gave you a property at 3 years ago's price, doesn't matter what property it is, you would all say, yes, I will buy it. The same thing applies 3 years from now. You would all say, yes, I would buy it at 3 years ago price. So if you've got equity and you're not using it, if you've got money in the bank or you've got able to buy a property now, you need to do that. But right now you can do that with just paying 10%. You have to worry about your borrowing in 2 years' time. I'm not saying that you don't do your sums and overspend. Absolutely not. You must actually make sure that in 2 years' time or 2.5 years' time, you can actually borrow the money to actually buy that property. We don't want any defaults. But if you have $1 million in your bank at the moment or in your super, if you've paid off your house, you cannot live off that. So I once thought that if you had $1 million in your house is paid off, you can retire. If you have $1 million in the bank today, you're going to get 1.5% maximum. That's $15,000 a year. Nobody can live on $15,000 a year. So That is why you need to invest in property. That is why Australians on a per capita basis are the richest people in the world. We are more than Switzerland. It was Switzerland for a number of years. We've gone past Switzerland because we hold properties, we invest in properties, and property values have gone up. Now, I'm conscious of time, but you need to do this to generate wealth. I do give one-on-one discussions with anybody that ever wants it. I'm available. I, of course, don't charge for it, but I have the passion to help you accumulate wealth through property. I've done it myself. I would like to help others to do that. I'll finish off there and take questions. This is our team. If any of you wanted to call us, feel free to take our number and emails down. But I'll stop sharing now and we will take any questions. Thank you.